Warren Buffett's best quotes about business, investing, and life. Fear is the most contagious disease you can imagine. It makes the virus look like a piker. Fear is the most contagious disease you can imagine. It makes the virus look like a piker, encapsulates the potent psychological impact of fear, which can spread faster and wider than any physical virus. Fear preys on uncertainty and vulnerability, often leading to irrational behaviors and mass panics. Unlike a virus, fear requires no physical contact. It spreads through social interaction, media, and even our own thoughts. Fear's contagion can be amplified in crisis situations, overshadowing rational responses and exacerbating the situation. However, this statement also signifies the importance of managing fear. The real fight is not just against the virus, but the fear it engenders. Lessons learned include the need for accurate information dissemination, promoting resilience, and psychological support as integral to any holistic approach combating crisis. This underlines the idea that controlling fear is as crucial as controlling the physical contagion. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This statement encapsulates Warren Buffett's investment philosophy, emphasizing the value of quality over short-term bargain. A wonderful company is typically characterized by a strong competitive position, robust financial performance, and competent management. Even if acquired at a fair price, such a company's inherent strength and growth potential can lead to substantial long-term returns. Conversely, a fair company might appear attractive when priced low, but its mediocre performance could limit profitability and expose investors to higher risk. Hence, the statement underscores the principle of value investing, where intrinsic value is prioritized over market price. The lesson is that in investment, like in many areas of life, quality should never be compromised for the sake of a temporary discount. The pursuit of excellence, even at a higher initial cost, can yield more considerable long-term value. Price is what you pay. Value is what you get. Price is what you pay. Value is what you get, is a profound statement on the distinction between cost and worth. Price is the monetary cost of a product or service, a quantifiable figure set by the market, often influenced by supply and demand. Value, however, is more subjective and multidimensional, encompassing utility, quality, durability, and emotional satisfaction. A high price doesn't always equate to high value, and vice versa. This principle applies broadly, from consumer decisions, where cheap products might lead to lower overall satisfaction, to investments, where a high-priced asset might underperform. The key insight here is the importance of discerning intrinsic value beyond mere price tags. The lesson is to make decisions grounded in comprehensive understanding and long-term value, rather than being swayed by immediate cost implications. The pursuit of value over price can lead to more sustainable and fulfilling outcomes. Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless. This quote emphasizes the paramount importance of reputation over short-term financial losses. In business, monetary setbacks can be temporary and recoverable, but reputational damage can have long-lasting, potentially irreversible impacts. A company's reputation, built on ethical conduct, trust, and credibility, is a strategic asset and a competitive advantage. Any compromise on these values can lead to loss of customer trust, legal troubles, or diminished market value. The statement underscores the need for maintaining integrity in all dealings, even when faced with financial losses. The key lesson is the essentiality of ethical business practices in preserving reputation. The underlying insight is that prioritizing reputation over immediate monetary gain can ensure sustainable success and resilience in the face of adversity. The important thing is to know what you know and know what you don't know. This quote encapsulates the essence of self-awareness and intellectual humility. Recognizing one's knowledge helps leverage strengths, make informed decisions, and build credibility. Conversely, acknowledging areas of ignorance encourages curiosity, learning, and growth. It prevents the pitfall of overconfidence and its associated risks. This statement underscores the importance of continuous learning and the willingness to seek help or collaborate when needed. Key insights include recognizing the limits of one's understanding as a strength rather than a weakness, and viewing ignorance not as a flaw but as an opportunity for improvement. The lessons learned are to remain open to new knowledge, foster an environment that encourages questions and learning, and value intellectual humility as a vital aspect of personal and professional growth. You cannot make a good deal with a bad person. The statement reflects the intersection of ethics and transactional dynamics. A bad person assuming dishonesty or unethical behavior poses risks. Trust, a cornerstone of any agreement, is compromised, potentially leading to broken deals, stress, or even damage. However, the term good deal is subjective, dependent on individual expectations and outcomes. Key insights include understanding the fluidity of human behavior. People can change, thus labeling someone as perpetually bad could be limiting. Also, ethics vary across cultures and individuals. What's bad for one may not be for another. The lessons: exercise due diligence and establish safeguards when dealing with individuals known for dishonesty. Understand cultural and personal ethics variations. Consider the possibility of change in individuals, but protect yourself against potential harm. In essence, navigate the world with a balanced view of trust and caution. Just buy something for less than it's worth. This statement essentially encapsulates a basic principle of value investing, which is purchasing assets that appear underpriced. The principle is simple, but execution can be complex. It requires a deep understanding of the value of an asset, which often involves thorough financial analysis and a keen understanding of market dynamics and trends. However, it's important to remember that what appears to be less than it's worth might be priced appropriately considering risk factors or future prospects that are not immediately apparent. Therefore, careful due diligence is key. Additionally, while this approach might lead to financial gain, it doesn't necessarily account for ethical considerations. For instance, buying something for less than it's worth from someone who's unaware of its true value raises ethical questions. Thus, it's crucial to balance the pursuit of profit with fairness and integrity. Uncertainty actually is the friend of the buyer of long-term values. Your statement articulates an important insight from value investing theory. In essence, market uncertainty, while often viewed as a risk, can present opportunities for long-term investors. Uncertainty can drive prices down as investors sell off assets, fearing potential losses. This can result in mispriced assets, where the market price is less than its intrinsic value. For long-term investors, these are attractive buying opportunities. They can acquire valuable assets at a discount, banking on the belief that, over time, the market will correct itself and the asset's price will reflect its true value. However, exploiting these opportunities requires a deep understanding of the asset's fundamental value and a firm belief in the robustness of its long-term prospects. It also requires patience and the ability to weather short-term market volatility. This perspective underscores the fact that different investors can view the same market conditions in very different ways, depending on their investment strategy and time horizon. As in the case with marriage, business acquisitions often deliver surprise after the I-dos. This statement draws an analogy between marriage and business acquisitions, emphasizing the element of surprise and unforeseen challenges after the commitment, I-dos. In both scenarios, thorough due diligence is crucial. Just as couples might discuss life goals, financial stability, and compatibility before marriage, businesses conduct financial, legal, and operational reviews before acquisitions. Despite this, surprises may arise post-commitment, unanticipated liabilities in a business context, or unexpected personality traits in a marriage. Key insights: both situations involve a long-term commitment and require adaptability, resilience, and problem-solving skills. Both can bring unexpected challenges that test the strength of the commitment and require both parties to work together to resolve them. Ultimately, the statement underscores the inherent unpredictability in big commitments, whether personal or business-related, and the need for resilience, adaptability, and effective communication when these surprises occur. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This aphorism, famously attributed to Warren Buffett, encapsulates a fundamental principle of investing. Capital preservation is key. The idea is not to avoid all losses, this would be unrealistic in investing, but to prioritize risk management to minimize potential losses. Rule number 1 suggests investors should carefully assess risks and avoid investments that could lead to substantial losses. It underlines the importance of due diligence and research before investing. Rule number 2 emphasizes remembering and adhering to the first rule. It's a reminder of the potential impact of compounding. A significant loss can require substantial gains just to break even again. However, this doesn't mean one should entirely avoid risk. Rather, risks should be well understood and measured against potential returns. It's about making informed decisions and being mindful of the potential downside while pursuing upside potential.